Today's lecture we're going to be discussing the failure setup. And there are three basic situations that we should be looking at when we are trying to trade. There are a setup where the market is going our way, and in this case we are following the traders who have been successful in the trade. And there is the other setup where we are looking at when the traders have identified a trading point and they decided to take the trade, and then the market has failed to continue into that direction and it begins to reverse, and this is what we call the failure setup. Out of those two situations, which is the setup where the trade becomes successful and the setup where the trade fails, out of those two, is this too close or too? All right. Out of those two setups that we're looking at, we prefer actually what we call the failure setups. The failure setups are much more successful and they pay us much more than the setup that is a working setup. The setup where the traders have failed and now they're trying to exit their trading position, these are the setups where we are looking to identify, because this is the setup that is going to make us, as I said, the most money. So for example, if you remember from last week when we were talking about being on the right side of the market, we were looking, for example, at the euro dollar, if you recall, and we had a price point of 147.18. If you remember from last week when we were talking about the euro dollar, and we have identified a point on the chart where we said that this is a point, a decision-making point, or what we call a structural point, and this was from last week. Most of you were there. And we said that the number was the 147.18, and at that point we were looking, this was the last time we did the last seminar, and which was on the 10th, and this was the 147.18, and we have agreed that if it fails below the 147.18, then that would be a failure setup, and we should be looking for a capitulation or a big sell-off. And this is where we are today. We have moved from the 147.18, which was last week, what we did together, and we have identified it together live in the room, to 143.62. So you had about 350 pips sell-off, which within a week you would have made that amount of money on one contract. Now, so this is what we are trying to do, is to look at the price points or the significant points, and at these decision-making points, we want to know how the traders are going to act. They are supposed to be, like what we said last week, at the 147.18. At this point in time, they had three choices. A choice of sitting at the 147.18 and doing nothing, which is fair, okay, and we don't have a decisive move, so we're waiting at the 147.18. And if it does trade below the 147.18, we are going to go short, and if it holds above the 147.18, we can go long, and we can place our stop below the 147.18. Now take a look at this day here, which was the 10th. As you see on the 10th, we have traded below the 147.18, and then we turned around, we failed to hold the 147.18, and the result immediately, I mean, I want you to look at that day, which is the 11th, okay? Take a look at the 11th day here, because I'm going to walk you through this trade now twice, I'll show you this in the euro, and I'm showing you the euro is because we have identified it together last week. So if you look at that big red candle here, which is on the 11th, you would see that the market has, or basically was trading on Friday, last Friday, above the 147.18, and it started pushing higher. So at that moment in time, you will be looking to be a buyer, and you will be placing your stop and reverse right below the 147.18. And this here, if you would have scratched the trade, the long trade, and you would have taken just the short trade, now that here, and you would see as soon as it came below the 147.18, you had this capitulation. Why did we have this capitulation? Okay, guys, let's, because this session is recorded, so hold your questions until the end of the session. I will open it and then I will answer all your questions. So the way we do that, the way we identify that these points is that we look at what we call the price structure. The chart is made like a building, and it's built on structure. And these structural points, you will see them mostly in my charts with ellipses around them. So this, for example, is a structural point. This is a structural point to the upside. And you would see me, again, this is an explanation that we go through. I will show you, for example, on a different chart. But the 147.18 is one of the price points that goes all the way back. Now, as soon as it breaks or it fails to hold these structural points, then at that moment in time, all the traders that went long above this point are going to reverse and get out of this trade and actually go and take a trade into the opposite direction. The reason is most traders, most professional traders have reasons why they get into the trade. And when you go long, you have to go long for a specific reason. And as long as this reason stays, as long as this reason has not been negated, then there is no reason for you either to get out of the trade or to reverse and go into the opposite direction. So we had a buy above the 147.18 on Friday, and if it failed below and came back below the 147.18, then we are going to close our long. We're going to get stopped of our long at a scratch, reverse, and take it to the downside. And that kind of reversal is a trade that you would take and you stay in it for a long period of time. Allow it to work. Give it time now to mature, because these are the trades that are going to pay us the most. I will explain to you how we identify those structure points in a second. Now, just to show you another structural point, if you will, which is in the pound yen and in the pound Swiss. So, for example, in the pound yen, I'm just putting the chart up. One of our structure points is and you will see me whenever I'm teaching or I'm giving you those presentations, that these numbers are hold on. These numbers are identified. For some reason, my computer is stuck. All right, now we move. Okay, so for example, in the Japanese yen, if you look at the chart now, the daily chart is coming above you, and you'll see all my structure points are always in the sienna color. Okay? And once we identify them on a daily chart, so for example here on the pound yen, our structure point, which is right there, if you see that it's highlighted on the daily chart with an ellipse. So this means that going forward, anytime it goes above the 146.74, we are going to be a buyers. Every time it trades below the 146.74, we're going to be sellers. And you see on either side of the 146.74, you have at least 500 pips move. So for example, last night we traded above the 146, went all the way up to 146.92. So in the evening session, in Tokyo session, we bought it. There is your, this is how we put the structure points on the chart so that we can see, because whenever you're trading, you want to be able to take your decision very fast. And you want to be on the right side of the market. You don't want to start putting an indicator. You don't have time for that. You need to have your ability to make that decision fast. So, for example, yesterday, I'm just getting you to the beginning of Tokyo session. Right there, this is the beginning of the Tokyo session. We traded above the 146.74, so that was a buy, and our stop was right below here, right below the 146, and that means if it comes back here below the 146, we are going to get out of the long, and we are going to reverse and take it to the short side. So you went short maybe around 146.50. And there is the move. You took it from 146.50 all the way down to the 144.50. That's a 200 pip move in less than an 8 hour. And that is the power of, as I said, of the structural points. And so now I'm going to take you to the failure setup. And what does a failure setup mean? Take a look at the daily chart. Now, one of the structural points that we have in the pound yen, for example, any line that you see with a sienna color, you know that this is a structural point, and it is a decision-making point that on either side of this price point, we are going to make a trading decision. Above that we are going to be a buyer, and if I take that buy, this is where the failure comes in. You identify a price point, and then when the prices goes above it, like here, for example, then you take the buy. So right here, you're going to go long, and you're going to stay with it. And you would see that at this time, when we traded above 150, we got paid about 500 or 600 points. So this means that since the behavior, this means that in the next time it goes above 150, I should be looking for another 500 or 600 pip move. So right there, I'm just showing you one trade at a time. So on this day, for example, right there, we should have initiated a long, and we should be looking for a move all the way up again to the 160, at least to give me 500 pips. But if it fails and comes below the 150, this means that two things. One, I no longer have a reason to be long. Two, I will get out of my long position with a small loss, or I'm going to scratch on the trade, and then I'm going to reverse, because now this is a failure trade, and it means that the market should be going down. And that is your move. You took at least from 151, it took you to 146. You took another 500 pips to the downside. There is, see how big the move is? That is a failure trade. Now let's see if it gets back right here. Now it comes back up again to the 151. So what should we do, guys? It went above the 151 and it closed above the 151. Now we have a setup. Exactly. Now you have a setup, guys. It gives us, that setup gives us two things. We need to buy above 151.50. Two, it places our stop below 150, 150. So my stop is going to be as small as possible. And if it comes back below the 150, 150, then I'm going to scratch. I'll get out of the trade. And I also have a profit target, because every time it goes on either side of the 550 or 5150, it gives me 500 pip move. No, you don't sell. If it comes below it, Tom, you will sell. But above it, again, these decision-making points, you want to be on the right side of the market. So in order to pick a failure trade, you have first to identify the right side of the market. Then, when the market fails to stay on the right-hand side, it could be, of course, it could be any failure, a false failure, breakout, but in this case, it's not a breakout. Right? Breakout, it gets out of a congestion, but this here is a structural point breakout. So if it fails, then you have your exit. And look at this move here. The next day, it went above. It made a high of 153. So at least on the upside, if you bought it above 150, 150, you had about 150 pip move, because it took you from 151.50 all the way to 153.20. You had 170 or 150 pips move to the upside. At least you could have captured 100 pips from that. Now it comes back below the 150, 150. Now you're going to reverse and take it short. And then on the other side, it gave you another 100 points to the downside. And that is your decline. There was a little bit of noise, but at least on either side, you would have made money and you would not have lost. Now, we come here to another structural point, which is the 146.74. Guys, I'm going to answer all your questions. I mean, just let me explain something to you. I don't give, well, all the lectures that I give you guys are live screen, because I want you to see the real example, and I'm going tick by tick so that you can see the decision-making process that we're doing together. So nothing is scanned. I'm not telling you what should we or could we. I'm showing you live so that we can do the decision. Okay? So if you could hold your questions, because I don't want to get distracted and lose my line of thought, and I'm going to answer it all. So hold your questions, and I'm going to answer. I promise I'm going to answer all your questions. Okay? Well, since you have asked it, there is the basic difference is at a structural point. These are major points where a lot of decision has been being made on either side. Every trade, every single trade that happens in the market, it is the only thing is the epitome of disagreement. Every transaction is a complete disagreement. The only thing that two traders agree upon is only the price. But if I was going to go long, then I think that the prices is going to go higher. The one that I bought it from him is bearish on the market. That's why he's selling it. Otherwise, there is no reason for him to sell it. So at these points, at these structural points, these are the points where there are a tremendous amount of disagreement. There has been a lot of decisions that has been taking place at these points, and therefore going forward at this time period, you can expect a lot of volatility at this area, or a lot of buying and selling. And we have to take those trades. Sometimes one would take the first trade and it doesn't work out. You just get stopped out, and you can sit on your hand and watch, see which way the momentum is going, and then you can take the trade. So for example, if you see here, for 2 days right there, it is sitting at the 147. But if we know how to read the chart and we look at this, we can see that the first momentum push is to the downside to the 146.74. You had a bounce above it, but this bounce, you see this green candle, should have given us, if this move to the upside is a genuine move, if this move to the upside is a genuine move, then we should have seen this kind of move, because based on price behavior, traders do the same thing over and over again. So right here, right above the 146, we had this move from 146 to 174. So I should have had this green candle a continuation to the upside to take me back to the 151. But what happened the next day, I had a failure day to go higher, and now it is sitting right at the 146. So with this, taking a trade over here, it is a no-brainer. It is a gimme trade that you want to take it to the short side. And you want to stay with it because it's going to pay you. And look at this move. It took you from 146.74 all the way down to 142. In one day, you got paid 400 pips. Let me read your question again. I guess you can't, guys are not going to hold. I will come back to it, Philip. Let me finish this point, okay? Now, guys, we come back here. Look at this. This is a couple of days ago. We came back to the 146. See how this move? It went above it. You got paid. You got paid now the 500 pips. Look at this. So once you capture a structural point, you will be paid handsomely on either side of those points. Why? The only reason that this happened is that people were going short, and when the prices went above the 146.74, they assumed that it has failed to go down, and now the move is to the upside. And look at this, just taking both sides of the 147, the 146.74, every time it breaks, you get your 500 pips on either side. Okay? So I'm going to answer this, and then I'm going to walk you through the process of identifying, of how to identify a structural point and how to identify the failure. So I'm going to see Philip's question, and then I'm going to show you. So a structural point is one where price had shot away with high momentum previously, and so there is likely more supply than demand. The structural point. Not particularly, Philip. I will show you in a second. So let's take a blank chart. Whenever you want to be looking at, let's put a different pair. I'm going to put the pound Swiss. Now, in the pound Swiss, one of our structural points that we have picked, or we have been trading all of last year in the pound Swiss, is what we call 164, the 164.95. Okay, and these numbers will become your friends. Okay, these numbers will become your friends that you can begin to identify and trade on either side of them. It's 169.45. Now, you can see here, for example, when the prices broke below the 169.45, you had a big move, a 500 pip move to the downside. Right there, when the prices came above we should have been expecting a move similar, move to the upside. So yesterday, just looking at yesterday, if we're waiting for, this was yesterday's close, it came above the 169.45, so we went long. In the evening, as soon as it came below the 169.45, you're going to close the trade and you're going to reverse and take it to the short side. So the way we identify this, I will do it with the euro dollar now because somebody was asking about how we did that in the euro dollar. So the number is the 147.18. Now, you need to have as many points on the chart data as you can possibly have. And now take a look at this chart and guess where is the 147.18? Do you see it there? There is your 147.18 right there. And you can see when it failed to, right here it went above the 147.18, and look at the failure move to the downside, how far down it took us, all the way to the 125. This is the second time it went up to the 147.18, and this was in December 2008. So actually December 17, so it's exactly a year ago today. So coming into this year, to December 18, this is where we were talking on the December 10. If it breaks below the 147.18, look at the move. That is typical price behavior. That is classic price behavior. And these are the trades that you want to be looking at. So the first thing you do, you want to put in as long as just a second, Cobb. You want to identify these points, and you want to do your homework for, you put as many database, historically you want to go, my charts, when I put a daily chart, I want you to see how I format. I have on my daily charts 20 years. Exactly, that's what I'm putting for you. You put 20 years, and once you identify this price point is going to be there for good. So you guys, from now on, going forward, nobody here in this room is going to forget 147.18. Especially also if we would have been able to capture this move and take this money down. This is a 500 pip move, or a 400 pip move. That number, again, if you remember the tenets behind the theory of technical analysis, there are several components of the theory behind technical analysis, and that one of them is that human beings will do the same thing over and over and over again. And each price point on the chart here is a representation of somebody's success and somebody's failure. Somebody did on December 18 or 17, 2008, did actually go in and buy it at 147.18, and he has suffered all this pain to the downside. And there is a guy that on December 17, 2008 went short at 147.18, and he is rejoicing all the way down. He has made all this money down. So what happens is today, when the price come back, I guess so. So today, when the prices gets back to 147.18, okay, you would find that they would react on to the same price again. So, Colony, you're telling me about Soros. I will show you something about George Soros and this. Take a look. I'll give you a price point, all of you here. I'm going to type it here. See this number, 143.82? That was the low. This is where George Soros started covering the British pound in 1993. Let me show you. Or when the market started coming back. Let me put a weekly chart. And once you do this kind of homework and you do this, look at this, guys. In 1993, this is when this is the George Soros move. Look at this. It stopped right here, and that was the breakout move in 2002, the 148. Well, he made it. He made 10 billion. And look, guys, in 2009, it is still the 143.82. So when we do our homework and we identify these points, okay, now they become decision-making points, easy for us, that above this price point, we only want to be buyers. I mean, take a look here. I'm going to show you how easy this trade would have been if you would have done your homework. This was the decline of 2008. We would have identified the structure point of 148. Once it came above it here in January, even though everybody was bearish on the pound, you would be buying it because you would be expecting a similar behavior. That would be, and that is your move. You would have taken it from 148 to 170 if you're taking exactly. And this is, again, whose fundamental failure call, or who cares? I don't care. And you should not care. Your job and my job is to make money. Who cares, Gordon Brown, or who cares? It doesn't matter. Don't waste your time on who does what and why. Your job is to make money. That's it. Your job is to make money. Okay? I'll tell you what, we do our homework, as I said, every Sunday. Okay? And I'm going to give you all a Christmas present. In January the 3rd, which is Sunday, January the 3rd, we are going to do our year-end or the New Year trade planning session. That we sit and we are going to take the yearly charts. We're going to do our homework for the whole year. Okay? And I'm going to open the room for all of you as my guests as a Christmas present at no charge. You're all welcome. All what you have to do is go to the site, Spyglass, and register, and we will send you the password in the week before. I mean, let's say around the 28th or something like that. Yes, it is a Christmas gift. Okay? I actually did that for you here. See? So, you just go there and just sign up, and that's my Christmas present to you guys, all of you. So anyway, we will do that, and we will pinpoint the structure point. So anyway, let's go back now to identifying these points. So today, for example, if you go now I'm going to show you my chart on the pound dollar, for example. And you would see that every single structure point that we do, and some of these lines we have identified for a year. And today, for example, you can see that last Sunday, when we did the homework on the Sunday session last Sunday, our selling point was below the 163 or 16. And this was from last week. It started flip-flopping on both sides of it. But yesterday, that was the extreme failure. So even though you scratched on the trade a couple of times, that big failure from yesterday would have made back all those small losses that we had on the either side of the 163. And this is the failure setup, guys, that I want you to see. That is what is called the failure setup. Here, our selling point from last week was, I'm going to make it green so that you can see, was if it trades below 163.016, we are going to go short. Okay? Now, it broke. This is where it opened. It sold off a little bit, so we should have been short that day. Then it reversed and it went above the 163 and it gave us 100 pips to the upside. So what we should do, guys, is to put ourselves in the position now of the guys that are actually buying and took it long at 163.16. And we know that all of these guys are expecting that the move to be like this. 163.16, that move, look at this. I want you to compare this with this. So look at this move from 163 all the way up to the 166. So they're expecting the same move here again, because these are structure points. You're expecting this move. So we are all going to go long, and we're going to put our stop where? We're going to put our stop right below the 163.16. And if, look yesterday, as soon as it came back, that momentum, that sell-off is your failure. Not your person, but the failure trade. That is the failure trade. And you will get paid with it, with the momentum to the downside. And look here, this is our, you would see that as soon, and this is our, this is from last week. This was yesterday. As soon as it came below the 160, we give it a little bit of room on the intraday. Right there, you will take it short, and that is the move just in the overnight session. All right? So in order to correctly do the failure trade, you need to identify a point of reference, which first has to put you on the right side of the market. So like in the euro dollar, we identified the 147.18. So this means that we want to be buying above the 147.18. Our stop is going to be below the below the 147.18. And if it does fail and trade back below the 147.18, then we are going to go short. That is our failure. And you need evidence. You need proof that you are right. The beauty of the chart is if you know what you're looking for, it talks to you. The chart is not as ambiguous as you and I or most of the people out there believe. The chart is not that ambiguous. The chart speaks in a specific language. I'm serious. If you know what you're looking at or what you're looking for, okay, then the chart is going to give you the evidence or the proof. Either it will tell you that you're on the right side of the market or you're on the wrong side of the market. Here, let me give you an example. We have said that if it goes above 147.18, then it should go up. Now, what will be the exactly? What will be the evidence that we are right? Is that the price is to be above? I'm trying. Okay. What is the evidence that we are right above the 147.18? Is that the prices will be above it and it should continue moving higher. What would be the evidence that we fail? Is that it will come down and trade below the 147.18, and then everybody is going to scramble to get out of that trade. That's scrambling to get out of the trade. That exit, everybody's this mad rush to the exit. Okay, that mad rush to the exit is your evidence that you are reading the chart correctly and you're on the right side of the market. Okay? So, now it is, so now we get a point. You're going to measure the move above it and you're going to measure the move below it, and then okay, as far as profit taking, Coco, here is what you should be doing. One of the things that we do also is identify what we call a hierarchy of the trades. We identify the hierarchy of the trades. Not all trades are equal. There are trades of a stronger magnitude and there are traders of a smaller magnitude. So if it is a high magnitude trade, Coco, then you stay with the trade and give it room to work. If it is a trade that is not that powerful, that's not high probability trade, then you get out of the trade. I'm going to put the this is the that's for you guys. I'm going to answer your question. This is your Christmas present. Merry Christmas, everybody. Just go to the on January the 3rd, Sunday. I will do that with you on Sunday. I will share with you how we do these things on Sunday because we only have 4 minutes. But again, the hierarchy of the trade based on the structural point or the significance of the point. The stronger the significance, the stronger the point, the higher the hierarchy of the trade. Just go to the website, register, and we will send the invitations out. Okay? So alright, so just go to spyglasstrading and .co.uk. Alright? So, the structure point, Merry Christmas, Sega. The structure point is one of the highest hierarchy. A signal that you take from a smaller time frame or a smaller is, now just say, yeah, you just put your FX Street and that's it. Everybody that's in the room today is welcome to come in, or anybody in FX Street until, if you register before, let's say Friday, the New Year, because nobody's going to be in the office to do the registration on Saturday and Sunday. So anybody that we have his email before Thursday, before the New Year, is going to get the invitation. Yes, we always record the sessions, and you can come in and see them all the week. Okay? All right, guys. We're running out of time, so anyway, we will do our homework together. Just go to the website and sign up. Hold on, let me tell you where it is. Just take this link and type this link. This is where you're going to register, and you get your invitation for free. Okay? And you'll find the recorded right there, guys. Okay, Merry Christmas, everybody, and Happy New Year to all of you, and thank you, Maud, and Merry Christmas to you guys, Maud and Adele, and thank you very much, and Merry Christmas to you, and have a very happy and a prosperous year, and hopefully 2010 will be prosperous for all of us.